today's video, I'll break down what China's next move could be in the ongoing trade war, especially now that China has said it won't escalate with more tit-for-tat tariffs. I'll also talk about why AOC is advocating ban on congressional stock trading. And amidst all these uncertainties and recession fears, how did market perform today? Plus, as always, I'll wrap up with my portfolio update for day 39. Hey everyone, welcome back to Million Dollar SIP. Today is day 39 of my journey to reach $1 million by investing in TQQQ using my hybrid SIP strategy. I started my day, like always, by checking the open and close of the previous day's candle on the daily time frame to determine my daily investment limit. Then I switched to the 5-minute time frame. Around 9:15, the price dipped below the 12 EMA and bounced back quickly, which triggered my entry. So I bought 5 units at $46.33, investing $231 today. Before I get into the portfolio update, let me quickly cover the breaking news for the day. Well, it's escalated again. Tensions between the United States and China have erupted once again. But this time, Beijing is choosing a different path. On April 11th, China announced a steep hike in tariffs on American goods, raising them from 84% to 125% in retaliation to Washington's earlier increase to 145% on key Chinese imports, including semiconductors, electric vehicles, and solar components. But unlike past flare-ups in this ongoing trade war, China now says it will not engage in continued tit-for-tat responses. In a statement from the Ministry of Commerce, Beijing emphasized a pivot in strategy that they will no longer be drawn into an endless escalation of tariffs. Instead, they will be focusing on building long-term economic resilience, diversifying partnerships, and also revealing the cost of US aggression over time. So what does that mean? What can China actually do now? Let me break down the tools China may use next to counter US pressure and why they could be more powerful than tariffs. First is selling US Treasury bonds. But before that, what are US Treasury securities? They are like IOUs issued by the US government to raise money. So when someone like a country, bank, or investor buys a treasury bond, they're lending money to the US government. In return, the US promises to pay them back with interest over time. There are different types, but the most common are treasury bills, treasury notes, and treasury bonds. So China is one of the biggest foreign lenders to the US through these treasury bonds. So if China decides to sell a large chunk of these bonds, a few major things could happen. US interest rates could rise. So by selling treasuries, it pushes prices down, which sends yields, which is interest rates, up. Higher yields means it is more expensive for the US government to borrow money. Next, the dollar confidence could shake. Global investors might question the stability of the dollar if a major holder is offloading it. But China also could hurt itself in this process. A sudden sell-off would devalue the remaining bonds it still holds, meaning China loses money too. So even if there is political tension, they will likely move slowly and strategically, not all at once. Why does it matter to you? Even if you're not an investor yet, these moves affect your mortgage, car loan, and credit card rates. They also impact stock markets. And these moves play into global power shifts between the US and China. Even a small signal from China that they are considering selling treasury bonds will shake Wall Street. So the second tool that they could use is tightening the screws on US companies in China. Apple, Tesla, Starbucks, Qualcomm, and Boeing are among the major US firms deeply embedded in the Chinese economy. China could introduce regulatory delays, random inspections, consumer boycott campaigns, tougher tax scrutiny or fines. In short, they won't slap tariffs, but instead they'll make doing business in China uncomfortable. Their goal is to pressure CEOs and US lobbyists to push back against Washington's aggressive trade stance. The third tool is export controls on critical materials. China dominates over 70% of global rare earths production and controls key segments of the supply chain for lithium ion batteries, solar panels, EV components, graphite, gallium, and germanium. In October 2023, China had already restricted exports of graphite, a key material in EV batteries. So, if China widens these controls, it could choke off crucial supplies to US industries, slowing down tech, clean energy, and defense production. Next is strategic currency devaluation. By weakening the yuan, China can make its exports more competitive globally, effectively cancelling out the impact of US tariffs. So how does this work? A lower yuan means cheaper Chinese goods even with tariffs. It boosts export volume and softens economic shocks. But there are also risks for China in this. This could trigger capital outflows, and it may invite global backlash or currency manipulation accusations, and this could also stoke inflation at China. But if used subtly, it is a powerful balancing tool. Next, the most important is deepening global alliances by ditching the dollar. China is doubling down on trade ties with EU, where it is negotiating a minimum price agreement on EVs to avoid EU tariffs, and also with BRICS nation and Africa offering infrastructure investment, loans, and yuan-based trade. And it is also trying alliances with Russia and the Middle East, pushing for oil and gas trade in yuan or local currencies. This shift is meant to reduce reliance on the US consumer market, which will weaken the dollar's global dominance and promote the yuan as a legitimate reserve currency. Xi Jinping's visit to Europe this week underscores this goal, building a counterbalance to US economic influence. So to conclude, China isn't backing down. It is just changing tactics. By refusing to match tariffs tit for tat, Beijing avoids playing a losing short-term game. Instead, it's turning to long-term strategic moves that undermine US financial leverage, empower Chinese self-reliance, and forge new global partnerships. So this isn't a trade war anymore. It is a power play. Next breaking news. JP Morgan has raised the chances of a US recession to 60% by the end of 2025 due to ongoing uncertainty. And yet, despite all this, the market closed in green today. S&P 500 up 1.81%, Nasdaq 100 up 1.89%, and Dow Jones up 600 points. It's been a wild week, especially Wednesday's massive rally followed by Thursday's dip. Total roller coaster. Speaking of Wednesday's rally, AOC is advocating for a ban on congressional stock trading, citing suspicious trades during recent tariff volatility. She argues that members of Congress may have exploited insider knowledge, especially after Trump's tariff pause announcement, which caused market swings. Some Democrats are calling for investigation into potential insider trading. Let's see what happens. Also, did any of you notice right before the Trump's 90-day tariff pause announcement, he posted on Truth Social saying, "This is a great time to buy." Let me know in the comments what you think of that. Now coming back to TQQQ, it closed at 48.58, up 5.29% today. Compared to last week, TQQQ is up 18.5%. Now my portfolio update. My total investment till date is 8547 with 139 units in my holdings. Today TQQQ closed at 48.58, which means the market value of my holdings is $67.53 and the average price per unit is 61.48 trade, which means I'm sitting on a net loss of $1794, which translates to a 21% decline. Since I started, TQQQ is down 46%, but my portfolio is only down 21%, which means I have outperformed TQQQ by 25%, thanks to the hybrid SIP strategy. That's it for today's update. If you found this helpful, make sure to like the video, drop your thoughts in the comments, and subscribe to follow the journey. Thanks for watching. See you tomorrow.